Hey everyone, Atlantic here from WhaleCoin Talk Academy. In this episode, we will be learning about dollar cost averaging, or DCA for short. It is seen as a safer, more reliable way for trading. But why is this? Let's find out. Now, what exactly is dollar cost averaging? Dollar cost averaging is an investment strategy in which an investor divides up their investments across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. These purchases can occur regardless of the asset's price and at regular intervals. So, for example, let's say Bitcoin is your chosen asset. You can decide to purchase $1,000 worth of Bitcoin every week for a year, meaning in total you spend around $52,000 on Bitcoin. But instead of risking it and buying it at one set price, you follow the market trends and sometimes get a really good deal compared to the initial price and sometimes a less good deal. Dollar cost averaging will only work if the asset increases in value over time. In this example, the majority of predictions say that Bitcoin will increase in value in the longer term, meaning it can be a smart way to trade Bitcoin due to its volatile nature. Now let's talk about some pros. It's a great method if you don't know much about technical analysis and or don't want to risk timing the market correct. If you just commit to buying at time intervals, it reduces the emotional traders making rash decisions. If the trader doesn't allow themselves to panic sell on a dip, then longer term, they can actually make a lot more. Now let's talk about some cons. Dollar cost averaging is not a substitute for finding good investments at the correct time. If you are willing to do the research and put in the time and discover gems before they take off, you can make a whole lot more. If the asset fails to increase in value over time, then it could have resulted in you buying it at higher prices. Overall, if you are a less experienced investor and want to reduce your exposure to wild market swings, dollar cost averaging could be a good approach for you. On the other hand, if you are an experienced trader, you might be able to get better returns by actively strategizing rather than going for dollar cost averaging. Thanks for listening, everyone. Tune into our next video on how to set up a wallet. I hope you were able to take away something from this video. Comment down below if you've ever used dollar cost averaging and if it's ever been effective for you. Make sure to like, subscribe, and check out our social links in the description down below. We have ongoing giveaways, so come join the community. Take care, everyone, and as always, be well.